Hello everyone, welcome back to SmallCapGuy. In this video, I'm going to show you part 1 of the 3 guaranteed ways to lose money. Maybe in your mind you are thinking now, what the shit teaching me how to lose money? I want to tell you that this video will actually be beneficial to you. Remember to watch this video till the end to understand how to mitigate or even avoid the pitfalls. I would also show you a better strategy to preserve and grow your money safely. Before I start sharing those surefire ways to lose money and how you should avoid them, I want to first explain what is the definition of losing money. The most typical definition of losing money is capital loss, meaning to say you put your money into some assets hoping the value would go up, but in reality they go against you like most of the investments you have done. Now there is also another definition of losing money that is about capital gain. Yes, you heard it right, capital gain. It means that the speed of capital gain does not catch up with the decrease in value of money over time. I will explain more about this in the subsequent videos of this series. Let me quickly move on to the first way to lose money, which is the focus of this video, and it is called insurance. Now, don't get me wrong, insurance itself is a really useful product and you must have it. But the problem is that insurance companies have been repackaging and bundling different products together and make it the best plan you need to ever have, at the same time draining more money from you. I would like to first share with you the basics of insurance so you would know which are the ones that are useful to you and which ones you need to avoid having them. There are two main parts of insurance. The first part is called protection, and the examples are personal accident and hospitalization plans. The other part is called investment. The examples are investment-linked plan and endowment plans. I want to clarify that my classification of the products here may not be the same as the insurance companies, and I didn't cover individual products like term and life insurance. I just want to give a brief introduction and not to go into specific products. The keyword here is cash value. Investment products would have cash value and protection products don't have cash value. Most of the time when you are approached by insurance agents, their sales pitches would usually be our returns are higher than the banks. Prepare your retirement fund earlier, save your kids' education funds while they are still young. These kinds of insurance agents are selling investment types of products. Comment below what kind of fantasy dreams your insurance agent sold to you when they were pitching their products to you. Now let us move on. How come insurance agents are focused on selling investment products but not focusing on protection? The reason is when insurance agents sell investment products, they would receive way higher commissions than selling a protection product. Now, I'm not able to show the exact commission rates here due to confidentiality, but you could easily Google and find lots of articles that are talking about the same issue. I will also put some links below at the description for your reference. In addition, those investment products typically require you to commit for a long period, minimally 10 years up to 25 years. And how the products work is that if you take out your money before the lock-in period, you get very little return or even lose your capital. Let us look at one example I found from the internet. It shows a 15-year endowment plan where a person have to put in $15,000 every year for 10 years. we look at the best case scenario where the insurance company is able to make a 4.57% investment return every year. As long as the person decides to withdraw the money within 10 years, the money that he could get back is always less than the capital he puts in. The only chance where this person could get back more money than his capital is during maturity in year 15. For the best case scenario, this person will be getting $214,000 with the investment of $150,000. We can do a simple calculation to see what is the compounded annual growth rate of this policy. You can see that in this case, this person is only getting 2.4% every year. This result is terrible if you compare it with the safest way to grow your money, which is to invest in the S&P 500 index. The average annual return of S&P 500 from 1926 to 2018 is about 10 to 11%. We will use 10% as our example. So, assume that this person is putting $15,000 each year into S&P 500 for the first 10 years and then hold for another 5 years. How much he would receive at the end? First, during the capital injection phase in the first 10 years, he would have already generated $277,000, which is more than the return that endowment policy gives out for 15 years. Then, for the next 5 years, there is no capital injection. We would take the $277K to grow at 10% for the next 5 years. The end result is $447,000, and this is more than double the return of the endowment plan. So, I want to make a conclusion here. If you buy an investment product from an insurance company, you would lose money regardless of whether it is for the short or long period. Buy the insurance products that are mainly for protection and not for investment purposes. Protection products such as personal accident and hospitalization plans do not have cash value, while the investment products do. However, depending on which country you are staying, it may not be applicable for you to buy protection-only products. It has become a norm that the insurance companies of certain countries bundle both protection and investment products into one. In this case, you can choose the product with a higher protection component than the investment component. If this video has been helpful to you, press like and subscribe to the channel. This channel is about sharing practical tips about investing and personal finance from my investing and coaching experience. In the next video, I'm going to review to you other surefire ways for you to lose money in the long term, so stay tuned for that. If you don't want to miss any of the future videos, turn on the notification for this channel. Looking forward to see you next time.